All right. Welcome, everyone. Welcome to the Market Wrap. Interesting week this time. We had news coming in from US, lots of tweets floating around, and then the markets fell. Sir, we'll decode all of that, but let's first start with the outlook. What is happening in the markets right now?
Yes. Hi, good evening, Vishu. So overall, the same story is getting repeated even this week. So this is the fifth consecutive week where markets have been tracking tariff-related developments, and we have seen FI sell-off, rupee depreciating, and as a result, markets have lost about 1%. But they have closed, or they're still holding about 24,500 kind of a levels, which has been held since the past 2.5 months. So that way, yes, things have been sort of in a consolidation mode for the market and likely to remain so. And I think when you look at the development on the tariff front, again, you have an extension of deadline. Uh, uh, Countries like India have been put at 25% kind of a tax bracket. So from that perspective, bit disappointing. But I see sort of for some of the countries where the tariff deal is also done. So for example, Vietnam, they've closed at about 19, 20 odd percent, and they're still sort of looking to sort of negotiate. And also, even with Europe, also, I think while they have committed while they have got 15% kind of a tariff, not enough clarity is there as to which country, which company is going to invest the kind of money which is being promised. So I see a lot of ifs in this entire deal, and I don't see even a week down the line or probably some months down the line, you'll have enough clarity. It looks like that we'll have to live with this tariff-related volatility for some period of time. And I think earning that way is not helping as of now. Earnings have been okay. Overall growth is about 8 odd percent, which is what we are expecting for the full year. But you need far more better set of numbers to sort of drive the market higher, which is why I'm not surprised that markets are consolidating for the fifth consecutive week. But having said that, since markets have taken support at or 24,500 levels are held, but it is possible that if this volatility extends further, then markets will take support at say 24,200 kind of a level, which is your 200 EMA level. On the resistance side, you will have 25,300 levels. So unless those levels are not really surpassed, it's very difficult to expect for some directional move. So till that time, I think we are going to be in a box in a certain sort of consolidation mode with little respite. Although we have RBI policy, nothing much is expected. Fed policy did not give much direction. And I think this consolidation or corrective mode in the market is likely to be there. And we've seen even the mid caps and small caps also sort of correcting. So I think overall, this scenario is still going to sort of persist, and the clarity is still sort of not there. And I am not really very hopeful of a clarity coming in soon on the tariff front. So I think, yes, some bit of a challenge or consolidation mode we are into, and likely to remain there for some time.
Absolutely. Let's start with the results season once again. Capital goods, quite a few companies declared their results. What happened there?
So yes, I think capital goods, I think a stellar set of numbers from a big boy like say L&T. I think L&T delivered a very strong set of performance. Order book or order inflows have grown by 33 odd percent. Their order backlog is up about 25% to 6 lakh crore plus. Their order pipeline also has improved from 9 lakh crore to nearly 15 lakh crores. And I think this quarter they have seen a pretty good execution. So 16% kind of a top line growth, good margins. PAT was up 30%. So I think this is clearly one of the few companies where there has been a positive surprise on many fronts. And I think overall our sense is that they'll sort of continue to do well, and our overall expectation is that this company will deliver about 14.5% kind of a top line growth and about 19% kind of a bottom line growth. So company is maintaining 15% kind of a growth, but I think this is one company among all the results have been a clearly outlier set of numbers. And again, to highlight one more company, KEC International. See, we have been highlighting that our T&D space is looking interesting. KEC International also came up with a pretty good set of numbers. The revenues have grown by 11 odd percent. And again, the execution on the T&D side has sort of gone up to 26 odd percent, which is the bulk segment for them as of now. And I think order inflows have been also pretty good at overall order backlog is about 34,000 odd crores plus they've got L1 of nearly 6,000 and they're guiding for around 30,000 crore kind of order inflows. Again, pipeline for this is again pretty robust at about 1,80,000 odd crores. So our sense is that this company again will continue to sort of keep doing well. Top line growth would be about 14 odd percent is what we would expect, but since the margins are going to expand, so our sense is that the bottom line growth would be even more higher at about 52 odd percent. And again, we are liking this company with a buy recommendation. So both L&T and KEC International, good set of numbers. And I think this capex as a theme is not disappointing us. And I'm quite positive on this capex as a theme as of now.
Absolutely. Closely related, Ambuja Cements as well declared its results. What happened there?
So yes, Ambuja, like other oil companies, delivered good set of numbers. We have seen revenue growing by 20 odd percent, 20% volume growth. And again, if you sort of strip out the inorganic, because this company has been a buying spree. So organic volume growth is about 13 odd percent. Realization is up 3%. And then again, EBITDA is about 1,060 odd. What the company is guiding is nearly a 350 bips, 350 rupees per ton kind of a reduction in cost, and somewhere about 1,500 kind of EBITDA per ton. And again, so see, one thing what we are sort of clearly noticing is that Ambuja some point of time was guiding for 6 to 7% kind of a volume growth. I think they have slightly revised it upwards to 7 to 8% kind of a volume growth, so which is I think is a key takeaway for me. And we've been liking the entire cement as a space, and Ambuja also valuation wise compared to Ultratech, it is attractive. Not to say that we don't like Ultratech, but Ambuja also looks attractive to us with a target price of 700.
Absolutely. Next up, we have FMCG. I think Hindustan Unilever, the investors were very happy with the results. What happened there, sir?
So I think while I'm not too sure whether the investors are happy, but I think this entire tariff-related volatility is putting FMCG in a sweet spot, because this is one of the few sectors which is not really going to get impacted by any tariff-related issues, even if there were to be a slight slowdown in GDP also because if the tariff remains at elevated levels. I don't think FMCG will get impacted. So FMCG is getting that momentum because of that. Now, coming specific to results, some key things are sort of standing out. One, there is a marginal or sequential improvement in the volume growth of 1 to 2 odd percent for whatever companies. Gross margin is still under pressure, and overall sense is that the revenues will grow in mid single digits. Now I'll come to company specific. HUL, see last quarter, one quarter before Q4, they were doing volume growth of 2%. This quarter, 3%. Gross margin declined. Profit again, marginal decline. But what the company is doing is that now instead of chasing margins, they are chasing volume growth, and which is clearly getting reflected in the numbers. And that is how I would expect things to sort of pan out. Company is also guiding for margins to stay in this range of say 22 to 23 odd percent, and earning growth again single digits. So my sense is again, all these FMCG counters are going to give FD kind of a returns. Asian Paints again, Q4 volume growth was 1.8 odd percent. This quarter is 3.9 odd percent. Again, gross margins were flat. EBITDA margins sort of declined. Profit declined. Again, company is guiding for single digit kind of a growth. So again, the overall sense is that margin came at around 18 odd percent and likely to remain in this range of 18 to 20 odd percent because the competitive intensity is still very high. So again, FD kind of a return in both HUL and Asian Paints, we are maintaining hold. Dabur again, revenues have grown by about 2 odd percent. So for example, for them, a lot of business is seasonal portfolio. So if you sort of strip that out, the volume growth is about 4 odd percent. Or sorry, 3 odd percent. So from that perspective, again, uninspiring sort of numbers. EBITDA was flat. Management is talking of double-digit growth, but then again, it is going to be held by lower base effect. So from that perspective, I am not really Very gung-ho on the FMCG set of numbers. Yes, from a momentum perspective, till the time markets are volatile, this sector can do well. But I wouldn't recommend to sort of chase this sector. Within consumption, if I have to highlight Vishu, I think liquor companies came out with good set of numbers across, and I am going to highlight two companies. One is Allied Blenders, which have been positive for quite some time. The other one is Radico Khaitan. And again, similar story because for both these companies, the prestige and other or the above segment is continuing to sort of grow, and that is a business which is commands better margin, better pricing. So which is why you'll see a far more better bottom line growth. Now coming specifically, ABDL did 22% kind of a revenue growth, and again 17% growth in volumes. One thing also is that last year you had lower volumes because of elections, and on top of it, I think you had markets like Delhi and I think AP were not there from a volume growth perspective because of the change in policies. So that also sort of helped. But I think for this company, Prestige and above segment grew by 47 odd percent. Margins expanded by 230 odd bips. Profit for this company grew 5x. So we continue to sort of like this company with a target price of 585. I think it's a portfolio stock. It's a very structural sort of a consumption compounding story. Radico Khaitan, I think, has been already sort of doing very well. Again, this company delivered about 33% kind of a growth. Volume growth was 38 odd percent. Prestige and above segment grew by 41 odd percent. EBITDA margins again expanded by about 230 odd bips to about 15.5%, and profit grew by 75 odd percent. So I think within the consumption, I think rather than sort of looking at a typical FMCG, I think liquor as a space is looking a lot more better and exciting to us.
Absolutely. Next up, we have defense. I think Bharat Electronics and Mazgaon Dock come up with their numbers. What do you think about these companies?
So one thing is very clear in defense, the order pipeline is quite robust for whichever company you sort of talk of. Now coming specific to say a company like Bharat Electronics, Bharat Electronics is one of the few defense stocks which always gives a very stable set of numbers, a stable set of margins. And I think from that perspective, we are not disappointed with the outlook. While the revenue has increased by 5%, typically you should see this company from a yearly perspective. Now, again, management has guided for a 15% kind of a growth, EBITDA of about, say, 27% plus. And again, this company has a good order visibility of nearly 80,000 odd crores, which is 3 times of the current revenues. And I think pipeline, like I said, is quite strong because our sense is that the review order for QR SAM worth about 30,000 odd crores, which will get decided by Q4 or Q1 of next year. So visibility is definitely going to improve for this company. Company is already guiding for a good amount of volume growth, this particular order inflow growth for this year of about nearly 27,000 plus crores. So this is one of the few companies which is very stable. We are expecting about 17% kind of a both top line and bottom line growth. So within defense, if this stock witnesses bigger correction, then I think this is one of the first stocks one should buy. Coming to Mazgaon Dock, now Mazgaon Dock numbers are volatile because the revenues have grown by 11 odd percent. But then again, margins have contracted sharply from nearly 24, 25, 6 odd percent to about 11.5%. Because of higher provision in some of the contracts and project-related expenses. Now, again, like I said, pipeline remains to be very robust. For current order backlog is about 30,000 odd crores, which is about 2.5 times of their revenue. But in the next 1 year, the expectation is that the government has to decide on 3 submarine projects, which is Scorpion of about 32,000 odd crores. And then there is a project called Project 75I, which is stealth submarine of about 90,000 odd crores. If this get decided, then from nearly 30,000 odd crore kind of order backlog, this company will get an additional about 1.25 lakh crore kind of order backlog. And which is why we are maintaining a hold. It is again contingent upon when it gets sort of decided. But like I said, the order pipeline for defense in general remains pretty strong, even for companies which are slightly volatile.
Absolutely. Sir, next up, what do you think about the steel players right now?
So we have seen good correction in Tata Steel. Tata Steel we have been sort of watching for. So again, I will highlight two, three things. So when I look at most of the steel companies which have sort of come out with their numbers, what has turned positive is last quarter was about 3 to 3,500 rupees increase in the prices plus coking coal cost of correction of 10 to 15 odd dollars per ton. But most of the players had witnessed a shutdown in the plant, so which is why there was a negative operating leverage, and which is why there was a limited benefit on the EBITDA per ton. So, for example, JSW Steel, the EBITDA per ton improved by 1,800 rupees per ton. For sale, it was even lesser at 450 odd rupees for different reasons, and Tata Steel at about 2,500. But our sense is that going forward, because both JSW Steel and Tata Steel are commissioning their 5 million ton new capacity, so volume growth is expected to sort of inch up. And then volume growth will be there, and then there'll be lower coking coal cost. So our sense is that these kind of EBITDA levels would be maintained going forward. And I think China is witnessing a lower amount of production. So I think that is also a sort of a healthy sign for us, at least for the month of June. So we need to see how things sort of pan out in the future. But we continue to like Tata Steel because of the attractive valuations. JSW valuations are rich, but Tata Steel continues to be our favorite pick with a target price of 200.
Absolutely. What do you think about its cousin's recent acquisition of Italian cars, the Tata Motors?
So again, Tata Motors acquisitions have not been very fruitful if I go by the previous examples, and we are not very excited even with this acquisition also. So although it's an Italian CV manufacturer, they are paying about 38,000 odd crores valuations at which they are paying is quite attractive. It's 0.3 times price to sales and 2 times CV by EBITDA. This company is double the size of Tata Motors in CV and margin of about 6.3 odd percent. So unlike JLR, it's a company which is which is FCF positive. So that is a sort of a change. And plus, I think they've got a sizable market share of 11 odd percent. See, our sense is that this acquisition is relatively better, but not very strategic because when you acquire a luxury car portfolio, the amount of spending you need to do is quite high because every year, every certain time frame, you need to sort of bring refreshes, and that is how you are able to sell. So, which is why it's a very costly phenomenon. Compared to that, CV is a segment where you need not really keep bringing out refresh version every certain period of time. So that way, I think capital requirement is expected to be lesser. The other challenge with Italian player or Europe in general is it's very difficult to bring down cost, and we have seen Tata Steel and a lot of other players sort of struggling to sort of bring down cost because manpower is something which you can't really do much about. So I'm still not very hopeful of this acquisition being very fruitful. But since the valuation it is getting acquired is relatively attractive, so which is why our fair value for Tata Motors is about 750. So on lower levels, yes, it is an attractive level, but from a synergy side, we are really not very gung-ho from that perspective. But let's see, I'm keeping my fingers crossed, but it's not as damaging as or as taxing as what JLR had been in the past.
Absolutely. And finally, this is time for the hidden gem of the week. Which will it be this time?
So Vishu markets are volatile, so which is why I'm recommending a segment where things are less volatile. So I'm recommending Rainbow Children Care or Medicare Hospital. So again, this is something where we see less volatility. So Rainbow Children Medicare is a leading chain of pediatric multi-speciality. They operate 20 hospitals with a bedding capacity of nearly 2,035, and they are expanding nearly by about 850 odd beds in the next 2-3 years, and capex of nearly 850 odd crores. Now, the reason for liking this is one of the few companies which has got the strongest EBITDA margins of 28 odd percent. Past 13 quarters, they have been maintaining EBITDA margins of 28 odd percent. And even in the last quarter, while we have seen revenues growing by 7 odd percent, but then again, EBITDA margins have been about 29.4 odd percent. And lower revenue growth is again not because of any other issues, but it is largely because of lower occupancy. And again, because the company is focusing on more on specialty care rather than sort of delivery related cases. So from that perspective, I think this is one of the few companies in the hospital side which is making very good margins. Capex plans are in sort of tack. And I think it has got one of the highest sort of return ratios. So from that perspective, I think this is one of the few players in this particular cohort. Which is why I'm recommending this stock with a target price of 1870.
Absolutely. Thank you so much for that, sir. And thank you so much, everyone, for watching. If you have any questions, please put them down in the comments and we'll try to get back to you. Thanks again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.